Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the S&P 500 ETF, ticker symbol SPY. And we're going to look at this chart first and then immediately go to the volatility index because they're inversely related, and I want you to see how accurate these charts are when used as a tool for forecasting. So again, last week I drew my lines saying that we would bounce off of this support level and then move higher later in the week. We did just that. And the interesting thing is today we closed with a pretty significant red candle that's almost a bearish engulfing pattern right there. There's still a gap above the market. So what that means is we're probably going to move to fill that gap and then pull back from the gap, because if you're following gap trading strategies at the market guys, you'll know that 80% of the time after a gap fills, the price reverses from the gap fill point. So I'm going to erase these lines right here, and then I'm going to draw my lines for next week so you can see how accurate these charts are. So I think we'll move up just a little bit on Monday and Tuesday, and then I think we're going to pull back later in the week. You can see that the volume is also dropping down here as the price is moving higher, and that drop in volume is usually a signal that the buyers are starting to get tired. So let's take a look at the VIX. Remember, the volatility index is inversely related to the S&P, and I said that we would most likely rally up in the VIX and pull back from this resistance point. And that's exactly what we did, with the end of that line being my target. And you can see that we came within pennies of my target this week, and that is why we use the volatility index as a leading indicator. Remember, when the VIX is bearish, that is bullish for the S&P, and vice versa. When we see the S&P start to go up, we're going to see the volatility index drop. So what does that mean for next week? Well, we're probably going to go just a little bit lower, and I'm going to leave this line in place right here. We're going to probably go right exactly to that target price, and then I think we're going to bounce on the VIX, which again, remember, is bearish for the S&P. If I go back to the S&P 500, you'll see, again, this is my forecast for next week. So if the volatility index is going to rally, this is going to drop. Let's take a look at the Qs. That's the Nasdaq market, known as the power shares. I said we would move higher later in the week. Not only did we move higher, but we blew through my target price right here, and you can see that we moved right up to that blue line, which is the 20 period moving average. Now I'm going to erase all these lines right now for you and draw a clean chart. I think that this is still going to act as resistance up here. Remember what I said about gaps. Once that gap fills, then the price will most likely drop. There's an 80% chance that that will happen. But the interesting thing is, this too is just like a bearish engulfing pattern, and there's a minor gap up here. You almost could miss it if you're not paying attention. It's a very small gap. So I think that the Nasdaq could move up just a little bit more, and then like the S&P, I think we're going to drop. So I'll leave that in place so you can track the progress with that and the accuracy of these reports, and hopefully you'll build confidence in the charts so you can see how valuable they really are, again, as a forecasting tool. Now, if I look at a more broad-based index, and that's the Russell 2000, I said that we would bounce. I was very conservative on this because the price target was fairly low. We blew past that price target, and just like the other markets, we have very close to a bearish engulfing pattern. So I'm going to erase these lines right here, and being that the Russell 2000 is at a resistance point already, I think that we're going to leave that in place. I don't think the Russell 2000 is going to go as high as the S&P and the Qs, like I mentioned. I think the Russell 2000 is going to start to pull back from that resistance and basically maintain a price range within this trading channel right here. Now finally, let's take a look at the diamonds. I'm leaving that one for last. Usually I start off with that one. The diamonds, same thing, just like the other markets. We're in the trading channel. We came right to the gap fill point. Again, I said that we would rally later in the week. We did that. But you have to see, this is a bearish engulfing pattern. Let me go one more. Okay, this is a body, a red body that's engulfing the previous body. The gap right there has filled. We have a bearish engulfing pattern, and look at the volume. We have an increase in volume, which tells us that the sellers are motivated. So I'm going to forecast that next week we're going to pull back, and the end of that line is going to be my target price. Now, if you'd like to learn more about what we do at the Market Guys, go to themarketguys.com, click on the video tab right there, and it'll bring you to the video library where we have what we call market shots. These are very short educational videos. They're about 6 to 7 minutes long. I think the longest one is 8 minutes. And if you go to this page and scroll down, you'll see that there's a video that explains trading the gap. It'll talk about the 80-20 rule and how gaps fill and how 20% of the time they don't fill, and also what happens after the gap fills. Remember, I said in the presentation here today, 80% of the time after the gap fills, the price reverses, and you want to be ready for that. So thank you for joining us with the Market Guys. Have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.